Hello and welcome, everybody. I'm Vern Cushenberry, and I'm back with another market update. And let me start with the bottom line up front. Nothing has significantly changed about the markets or a well-laid financial plan. The fundamental tenets of success remain in place. Save 10 to 15% of your income. Be more aggressive when you're young. Dial that back as you approach retirement. Know that the markets on average have returned to 10%. Stay the course and work with your financial planner to solve for things like catch-up savings, taxes, healthcare expense, and estate planning issues. I have those written down because it's healthy for me to remind myself, because we all forget. I shot a webinar with one of our financial coaches this month on behavioral investing, and as life gets in the way, it's just helpful to have somebody there like a financial planner or a financial coach that can remind you of the underlying tenets of successful investing. So with that said, I'm going to jump into some of the detail, but if you're a very high level person, you can tune out there. Every quarter, I ask our investment committee for little nuggets that they'd like me to pass on, anything that they've heard from their clients or in investment committees or something that's on investors' mind. And this quarter, I got a joking response. Maybe it wasn't joking, but one of my partners asked if I could weave in Jeremiah 29:11. For I know the plans I have for you, plans for you to prosper, plans to give you hope and a future. So I read that and I'm like, I got to chuckle to myself. I'm like, oh, hope. I'm sure our clients will get a good laugh out of that as our underlying investment philosophy. And then I thought, no, that's not right. It's our job to know the markets, the history of the markets, the underlying fundamentals, those successful investment tenets well enough to give our clients hope. So that's what these quarterly videos are all about. When you're a market maven like myself and you've been doing this for 25, going on 30 years, your anxiety is fairly low because you navigate all this volatility with a broader perspective. That's the perspective I'm trying to impart in these little market update videos. So bear with me, and I hope to do exactly that. Let's jump into it. Okay, as you can see here, the last quarter was great. US stocks were up 10%, international up 5%. Bond market was about flat, but a lot of green on that chart. And if I fast forward to the long-term view here, you can see 1 year, 5 year, 10 years, green across the board. And domestically, we've been on a good run for the last 2 years. You can see the history of the S&P 500 index there, returning very nice returns this quarter. Now, I wanted to focus in on the 10-year Treasury rate. The Federal Reserve and the markets have been gathering all of the attention from pundits in the Wall Street Journal and major financial news outlets. And the parlor game seems to be betting on when the Fed start interest. And that has a big effect on the economy, and you can tie that back historically. So there's a rightful amount of attention that should be focused on that. Well, you can see if you go back and look at other major market peaks, like go all the way back to 2000, for example, the 10-year Treasury was at 6.2, and 2007 it was at 4.7. Today we're at 4.2, and markets increase interest rates until some crisis presents itself. A crisis may result in significant drawdowns to the stock market. But to be honest, the data is not significant enough to put much credence in that takeaway, but we are at or near past prior peaks. Now, what does that mean? Well, one insight, one takeaway that I've mentioned in the last 6 months is that investors have the opportunity to benefit from these interest rates today. The bond market is yielding 4.2%. Cash is yielding close to 5. So there's an argument for patience. There's an argument for conservatism in these markets. Let's look at expense ratios. Is the market cheap? Is the market expensive? This chart details that going back to 1994. You can see on this chart, the average over the last 30 years has been 16.62, low end around 13, high end about 20. We're creeping up over 20. So the market, by at least one measure, is expensive, which would again argue for a little bit of patience. Now we can take that data, we can look at this, and let me walk through this a little slowly for our audience, because at first it can look a little bit like an eye test. But what you're observing is returns charted on the vertical axis And those expense ratios, or those price to earnings ratios, charted on the horizontal axis. I mentioned that the market was looking a little bit expensive, up around, up above that 20 mark. Well, this is where the market is today. So if we look at that data point and we correlate it to all of the other data points going back over the last, I think this is a 30-year period, we can loosely correlate what our expectations might be going forward over the period of 1 year. Now, valuation estimates have very little predictive capability over subsequent 1 year periods. We're on a rising trend, a rising tide floats all boats, and that may very well hold true for the next 12 months. As we look out across the subsequent 5 and even 10-year periods, look at all those data points tighten up. They get much closer to that line of best fit. And we can see there that over the next 5-year period, with valuations at or where they currently are, we can expect, call it low to mid single-digit returns in the market, if history is any indication. And the second observation that I take away from a chart like this is, despite high valuations, which might indicate lower returns in the future, look at the relative dearth, meaning absence of data points underneath the zero line. It's still rare that when valuations are high, we would show negative returns in the future. So that's worth keeping in mind. Okay, this next chart draws out a very unusual occurrence in the market, something that Wall Street is calling the Magnificent Seven. If we peer into the underlying performance of the market a little bit, what we can observe is that the vast majority of these returns are being driven by a select few stocks that Wall Street is referring to as the Magnificent Seven. And those 7 stocks are Apple, Amazon, Google, Meta, Microsoft, NVIDIA. NVIDIA makes the chips that are powering AI, and Tesla. If we look at just those 7, notice this top line, the Magnificent Seven. Those stocks have returned 40%. Well, they were down in 2022, but in 2023, they returned 76%. 76%. Now look at what the S&P 500 did, 24%. If we back out just those 7 stocks, the S&P 500 would have returned 8% last year. That's a marked difference. My takeaway from that is, if you look hard enough, you're always going to be able to find pockets of inefficiency. So while the Magnificent Seven did so well last year, you might argue that the rest of the S&P 500 is not at valuation levels whereby we would expect more challenging returns going forward. That represents a more traditional, more conventional investing opportunity, and we can adjust our portfolios to reflect that, and we do. Okay, moving on to consumer confidence in the stock market. I wanted to include this chart this quarter because, like I mentioned, we did just complete that webinar on behavioral investing for all of our clients, and we went through some of the pitfalls that typical investors fall into when they're trying to interpret the headlines. We're all human. We all have emotions. We go home, we sit down, we turn on the news, and we feel our pulse go up, just with geopolitical events and major market headlines and so on and so forth. And the natural response is that we should be taking action. Well, if you look back at the history of the markets, that's contrary to what's most successful for our investing portfolios. What we need to be concentrating on is staying the course. And we can loosely tie these measurements of consumer sentiment, meaning our consumers or investors on average very positive about the markets or very negative about the markets. And there's a reverse relationship to those 2 data points, meaning that when consumers and investors are particularly excited about the markets, that also happens to coincide with the point that markets start to go down. So that's a problem. But if we know that, we can work on mastering those emotions, and the most successful investors throughout time have done exactly that. As I mentioned a moment ago, there are always pockets of inefficiencies in the market, and this is one that jumped out at me as I was reviewing the data for this quarterly call. I wanted to share it with everybody on the line. You'll notice here that we're looking at the international price to earnings ratios. At the top of the deck, I looked at the price to earnings ratio for the S&P 500, well, mostly domestic stocks. We can compare that to the all country world index, which excludes the United States. And what this chart tells you is that international stocks typically trade at a discount to US stocks. And that's appropriate because the United States has one of the most regulated markets in the world, and that's deserving of a premium. So if you think of that discount as approximately 15%, this line right here would be the average of what that discount has been going back to 2004. And the markets are volatile. Sometimes international stocks are going to trade above that average, and sometimes they're going to trade below that average. Well, as of March 31st, 2024, they are 34.5% beneath that average, which is a 2 standard deviation event, indicating that international is another pocket of opportunity that we might be looking toward in this market. Okay, lastly, or close to lastly, I wanted to make a few comments on the Federal Reserve and the rate hiking cycle that is getting a lot of attention these days. So this chart I thought might be worthy of sharing, just exactly what have past rate hike cycles indicated. Well, we can chart those, and that's what this chart on the left shows. What we're looking at here on the vertical axis is the percentage return to the S&P 500. And on the horizontal axis, we're looking at months since the last rate hike. So, pardon me, just jumped off the page there. So you can see that the 2022 to 2023 rate hike cycle is charted here in red. And we've had, looks like about a 15% return since the Federal Reserve stopped hiking rates. Compare that to each of the last 1, 2, 3, 4, 5, 6 rate hiking cycles there on the right-hand side of that chart. And you can see that, well, there's 6 data points. So my initial read on this chart might be that there's opportunity left to be had. But if you look at the 04 or 99 cycle, those ended with either negative returns or close to 0 returns before the economic cycle came back around and the expansion GDP started to grow again. So not enough data to come to a conclusion, but an opportunity for investors to just gauge what the market seems to be so focused on against what might be meaningful data if we look back through time. And my read on this chart is that this is not something I would promote to the very tops of my decision criteria. So with that, I will close and say thank you for joining me again for a quarterly update. On behalf of everybody here, I say thank you, and I'll see you again next quarter.